A quiet but persistent alarm is sounding in one corner of the U.S. economy, and it echoes from driveways and parking lots across the nation. A growing number of Americans are falling behind on their car payments. This is not a problem affecting the wealthy, yet it is a crisis brewing among households with lower incomes and weaker credit histories. For these consumers, the dream of owning a car is turning into a financial nightmare. The rate of missed payments on so-called subprime auto loans has climbed to its highest point in nearly 3 decades. This is a clear and troubling indicator that for a significant portion of the population, financial stability is eroding. The roots of the current crisis can be traced directly back to the economic upheaval of the pandemic. Global supply chains, the intricate web that moves parts products around the world, snapped. Automakers could not get the semiconductor chips, the chips they needed to build new cars. Production lines halted. Dealership lots, normally brimming with new vehicles, sat eerily empty. This scarcity created a fundamental imbalance between supply and demand. With far fewer new cars available, their prices shot up dramatically. The average price for a new vehicle climbed relentlessly, pushing past thresholds that were once unimaginable for a typical family car. The era of the bargain was over. This surge in new car prices had an immediate and powerful knock-on effect on the used car market. Buyers who were priced out of a new vehicle flooded the market for pre-owned ones. In some cases, 1-year-old used cars were selling for more than their original sticker price. And 2-year-old used cars were too. For consumers, there was no escape from the inflation. Whether they were shopping for new or used, the price of mobility had fundamentally reset to a much higher level. This new reality forced families to dedicate a much larger portion of their income just to secure transportation. Compounding the problem was the disappearance of manufacturer incentives. In a normal market, automakers use discounts, rebates, low-interest financing. These deals can shave thousands of dollars off the final price of a car. However, when dealers had more customers than cars, there was no need for such promotions. Incentives dried up almost completely. Buyers were left to face the full, unmitigated sticker price, and often, prices even higher than that. The power dynamic shifted entirely to the seller, and consumers lost a crucial tool that had historically made new cars more accessible and affordable for the average household. The result was a perfect storm of high prices and limited options. To manage the sticker shock of historically high car prices, buyers and lenders turned to a simple but risky solution: extending the length of the loan. A loan that was once typically paid off in 4 or 5 years began to stretch to 6, 7, or even 8 years. The arithmetic was simple. By spreading the same loan amount over a greater number of months, the individual monthly payment becomes smaller and appears more manageable. A $40,000 loan over 60 months might require a payment of around $750, but stretched to 84 months, that payment could drop below $600. For a family watching every dollar, that difference felt like a lifeline. Cars depreciate quickly, while the loan balance decreases very slowly in the early years of a long-term loan. Being upside down creates a dangerous financial trap. If the car is totaled in an accident or stolen, the insurance payout may only cover the car's current market value, leaving the borrower still owing thousands of dollars on a loan for a car they no longer have. It also makes it nearly impossible to sell or trade in the vehicle without rolling the negative equity into a new loan. This creates a snowballing cycle of debt. Each new purchase starts from a deeper hole. The short-term relief of a lower monthly payment conceals a long-term burden of amplified risk and escalating debt. The prevalence of these long-term loans has reshaped the landscape of auto finance. What was once an exception has become the norm. The average monthly payment for a new car has climbed past $750, and many buyers are now committing to payments over $1,000 per month. These figures take a large bite out of median household income. Consumers now have virtually no financial cushion. Any disruption to their income, a reduction in work hours, an unexpected expense, or a job loss can quickly make that once manageable payment impossible to meet, pushing them toward default. The data coming from the auto loan market paints an increasingly grim picture. The numbers act as a series of alarms, each one louder than the last, signaling deep-seated stress among consumers. One of the most telling statistics is the rate of serious delinquency for subprime borrowers. These are borrowers with credit scores typically below 620, considered high risk. The share of these subprime loans that were 60 days or more overdue recently surpassed 6.1%, a level not seen in almost 30 years. This is a critical warning sign. It shows the most financially fragile consumers are breaking under the weight of debt at a historic rate. The trouble isn't confined to subprime, it's just most acute there. Across the board, more buyers with weaker credit are entering the market. Approximately 14% of new car buyers had credit scores below 650, 1 out of every 7 customers, the highest proportion since 2016. As prices rose, lenders may have loosened underwriting standards to keep sales flowing, and when delinquencies rise, repossessions inevitably follow. In the complex world of auto finance, the recent bankruptcy of a lender named Tricolor Auto Group served as a stark and specific warning. Tricolor was not a traditional bank or credit union. It was a specialized lender in a high-risk niche. The company focused on providing loans to migrant consumers who often had little to no formal credit history. Many customers lacked a social security number. Tricolor built a business model serving an underserved and vulnerable population, growing to roughly 100,000 loans. Tricolor filed for bankruptcy amid allegations of fraud and misrepresentation. It was accused of using deceptive practices to make loans borrowers could not afford. Some analysts dismissed the case as isolated, pointing to large traditional banks and captive auto lenders as better capitalized and less exposed. A cautious view sees it as a canary in the coal mine. It reveals extreme risks in the subprime space, a combination of aggressive lending practices, vulnerable borrowers, and external economic pressures. External factors like shifts in immigration policy and enforcement can affect loan performance for specific groups. There is a clear and urgent need for the industry to recommit to producing safe, reliable, and genuinely affordable new vehicles. Lenders and regulators must ensure fair, transparent terms, with stronger oversight, caps on interest rates, and flexible options for hardship.